This meeting is being recorded.
Hello everyone, and thank you for joining us today for the webinar on fundamentals of UAE FATCA CRS compliances hosted by Nextime. Before we begin, please note that you are in listen-only mode. If you have any questions, please share them with us through the question box on the control panel. We will address your queries towards the end of the webinar or in writing if time does not permit us to cover them during our broadcast today. I would now like to invite Trupti Mehta to set the context of the session today. Trupti is the director at Nextime. She leads all business development activities in the GCC region and is responsible for growing the company's presence in this geography. Over to you, Trupti.
Thank you, Amira, and welcome to all the attendees of this very important webinar. I am sure that you all would have been very happy to see the extension for filing the FATCA CRS, which has been postponed to July 20th. And I think we at Nextime took this opportunity to make you understand the fundamentals of UAE FATCA CRS laws. So now, you know, the compliance with FATCA CRS is very crucial. And to avoid penalties and fines imposed by the authorities, it is imperative for all of us to comply with the regulations. While certain procedures and reporting may be complicated, compliance can be managed by financial institution if it is understood properly. And today's webinar is aiming at that only. Let me just introduce you to Mihir Shah, who is a practicing chartered accountant with 11 years of experience in domestic and international taxation, and also have extensive knowledge about treaty provisions. He has served clients at across various industries and sectors, including pharma, manufacturing, and financial services, and also the IT industry. So without further delay, I would just hand it over to Mihir to take you through this important topic. And I hope you all will learn something from this. So over to you, Mihir.
Yeah, Trupti. I'll just share my screen. Hello, everyone, and welcome you all to the important session on of UAE FATCA and CRS compliances. So we have been hearing of lately, you know, that UAE has increased compliances in terms of FATCA and CRS, in terms of FATCA CRS compliances. So, you know, let us understand what exactly is FATCA and what exactly is the CRS regulations that we have in place. So just to give you a context, you know, like what all we'll be dealing today is the broad overview on the FATCA CRS regulations. What are the financial institutions? What are the due diligence requirements that that entity needs to follow? And the newly launched reporting portal, because of lately we have been, you know, it has been given to understand that entities are facing a lot of issues on the portal. So we thought that it's a good area. And lastly, the CRS risk assessment, which has been newly introduced by the UAE authorities. So let us first deal with what is FATCA. FATCA is commonly known as Foreign Account Tax Compliant Act. Now, what was the need to have this act in place? Initially, the UAE, this basically FATCA law deals with the US regulations. So the US tax administrations, they were very curious that, you know, there are certain US persons who are based outside USA, and they are having certain offshore income, but they are not disclosing it properly to the tax, have a proper disclosure in place. So initially they had this United States federal law, which was enacted in 2010. But subsequently, there was a need because this law particularly was not so the law was not particularly more enacted powerfully that, the US persons were actually reporting this information to the US authorities. And hence it thought that let us have some regulation in place wherein the US authorities then have an agreement with each individual different countries. So let's say maybe UAE, Singapore, India. So they had this agreement with all the various countries wherein they wanted that let's have an agreement, and those countries will in turn share the information about the US persons to the US tax authorities. And therefore, in 2015, the agreement was signed with UAE authority that please ensure to have systems in place so that subsequent or for the subsequent calendar years, you can report the information on the US persons to us. So why we are saying that the agreement entered in 2015, but the effective date is 1st July 2014. So the genesis is that from if we go through the agreement, it says certain account holders who would be there with the entities prior to 2015. So they had kept a cutoff date. So the cutoff date was 1st July 2014, and hence we are saying that all the account holders who were there from 1st July 2014 till 31st December 2016 would be treated as a pre-existing account holders. That we will look into the coming slides. And subsequent to that, the account which has been opened after 2016 will be classified as a new account holders. It seems that the slide is not visible properly. So is anyone facing any issue or something? I'll do one thing. Let me just unshare my screen and I'll reshare it. Sorry. Yeah. So it seems there's some issue with the slides, being not reported properly. So I'll just continue with the presentation and we'll share it later on, the entire presentation with the audience. Yeah. So having said that, the cutoff date was 1st July 2014. Thereafter, the US authorities said that yes, finally there is some mechanism in place wherein they can have a curb on all the US persons who are not reporting this information properly. And therefore, we say that the tax authorities in US as well as in UAE have implemented in place wherein the entities which are based in UAE needs to submit the returns, and that information will be automatically passed on to the US authorities. Having dealt with FATCA, let's move on to the next slide, which deals with the CRS portion. Yes. So similar to the FATCA guidelines, even the G20 OECD members thought that why not have some regulation in place, which will ensure that the countries who do not have any agreement in place for sharing of information, they can bind those countries and have a proper mechanism in place. And therefore, a CRS regulations was launched in 2014, whereby all the participating jurisdictions. So when I say participating jurisdictions, it is the countries who have agreed to share information with each other. So it could be UAE and Singapore jointly agreeing to share this information, or UAE, India. And likewise, UAE became a participating jurisdiction from 1st January 2017. Because that was the date from which it became the participating jurisdiction, the first reporting was therefore concluded from 2019. And this is probably the third year wherein the UAE entities will be doing the reporting. So what is the overall framework for FATCA CRS? Who are the authorities involved? Who is required to do the reporting? So when we talk about the competent authority, it is the UAE Ministry of Finance who has the overall responsibility to ensure that each and every entity who is required to do the reporting does it correctly, and to improve in case if there is any lack on their end. So because as we know that UAE of Ministry cannot have an overall control, there were certain separate authorities which has been set up by them. And those authorities are the Dubai International Financial Center, the Abu Dhabi Global Market, and the central banks. So these particular entities. So initially it was that any entity which has been situated in this particular regions were required to do the reporting. Now it is so that even the non-regulated entities who are situated outside this particular region, let's say the entities are situated in Jafza zone. So even though if it is a free zone, but if the entity is engaged in doing any financial activity or it's classified as a financial institution, they will be required to do the reporting. Now, moving ahead, the main concept of the FATCA CRS lies that to whom this regulation applies. So first of all, to put it in a very simple language, I would say that there is a particular entity, company A, which is incorporated or registered in UAE, and it is classified as a financial institution. Then that particular entity will have to do the FATCA compliances. Second, there could be some branches of a company which is based outside UAE. So even for those branches, they will have to see that whether if it is classified as a financial institution, then they will have to do the reporting for FATCA CRS compliances. And the only exception which has been granted is that, let's say if there is an entity which is based in UAE and it has set a branch outside UAE. So for that particular entity, there is no requirement, because in that scenario, the branch of that particular country of that particular company will have to see whether, supposing if the company has incorporated a branch in India. So now the Indian branch will have to see that if it is a financial institution, then it will have to do the reporting with the Indian authorities and not with the UAE authority. So as we said that, the whole concept or whole genesis of the FATCA CRS lies in the financial institutions, the kind of financial institutions which are there. Let's have a look at what are the different kinds of financial institutions that has been provided in the regulations. So as a first step, there is the entities are classified in 4 different categories. One is the custodial institution, which means that the entity per se is holding assets on behalf of some other account holders. So if you are holding some custody of particular assets on behalf of somebody and you're earning income out of that particular, from that particular account holder, then you are classified as a custodial institution. The second type of institution would be the depository institution. So this is a very simple institution wherein if any institution which is accepting deposits in its ordinary course of business, so maybe purely it could be a banking institution or it could be a non-banking financial institution, which will classify it as a depository institution. The third category is the specified insurance company. Here, any insurance company which has issued an insurance contract to that particular insurance company would classify as a specified insurance company, and they would have to undertake the FATCA CRS compliances. The last category is the investment entity. So this the definition of investment entity, which has been provided under the regulations, is in two parts. So the first part deals with if the entity is engaged in a business of undertaking any in the business of trading activities of financial institutions, financial assets, or forex instruments on or behalf of a customer. So here the main and the major distinction is that the activity has to be conducted on behalf of a customer. Conducting such activities, then you qualify as an investment entity. The second category, the second leg of definition which has been provided is that if you are an entity which is managed by another entity and you are dealing into financial assets, then you classify as an investment entity. So let me try and put it in very simple terms. There is a company A which is already classified as an investment entity. That company A is managing company B, which is purely dealing in financial assets on its own behalf. Now, because the company B is managed by company A, which is already classified as an investment entity, the company B will also be classified as an investment entity. So the main step for identifying, whether the company or whether this FATCA regulation applies, that first there has to be an entity classification which has to be done. Unless and until this classification is done, the entities will be you'll be running from pillar to post to understand that whether these regulations apply or not. Because today what is happening is that the authorities are sending out the self-certification forms to all they are requesting them to fill up this self-assessment form. Now this self-assessment form is nothing but the information about the company and their broad classification under the FATCA regulations and the CRS regulations. So unless and until you have properly classified yourself, you would not be in a position to determine that whether these regulations will apply or not. So having talked about financial institutions, let's move on to see that what is a reportable financial institution and what is a non-reportable financial institution. And in fact, if we read the regulations also, the definition of reportable financial institution is given in a simple language that any institution will be a reporting financial institution if it is a non-reporting financial institution. So now, what is a non-reporting financial institution? So non-reporting financial institution there are under FATCA and CRS regulations, broad categories have been given that this particular institutions would be classified as a non-reporting financial institutions. So let us first have a look at what are the categories which are given under the CRS law. So first category is the exempt beneficial owners. Now these exempt beneficial owners are nothing but where the entity is wholly owned by your government organization or organization or a central bank. So if any entity which has been wholly controlled by these particular owners, then you're not supposed to undertake any reporting. The next reporting comes about. The next category is the retirement funds. So in UAE, there are broadly a broad retirement fund and a narrow participation funds. So these funds are basically for the benefit of the employees who are registered with the companies. So if you fall in this category, you are not supposed to undertake any requirement. Now the third category is a qualified credit card issuer. So what do you mean by a qualified credit card issuer? Credit card issuing company issues a credit card to the customer, and let's say that customer makes payment in addition to what is required in terms of its monthly payments, so then that particular credit card company would be classified as a qualified credit card issuer. So to give an example out here, customer A has taken a credit card from the company. He receives his monthly bills in which the amount payable was USD 25,000. Now the customer makes a payment of USD 30,000, which is in addition to the liability which he was required to pay. So that excess 5,000 which he has paid to the credit card company, if the credit card company does not reverse back that 5,000 customer and it adjusts that amount in the next credit card cycle, in that scenario, that particular company would be classified as a non-qualified credit card issuer. And they are not supposed to undertake any requirement. The structure is a very simple structure where there is no risk of any tax evasion. Those kind of entities are classified as a low risk FIs. Now, as I mentioned that, under the CRS categories, there are certain funds which are specifically given exemptions, but under FATCA, there are some additional exemptions also which has been given. So let's have a look at those. The first and the second category, which is the trustee documented trust and a sponsored investment entity. Though the categories are different, but here the main object is that if a sponsor is taking a declaration, is giving a declaration that I would undertake obligation for the entity to whom I am a sponsorer, then that particular entity is not required to undertake any obligation or a reporting under the FATCA CRS compliances. So here also, there is a trust which has been opened by a particular person, and there is a trustee to that trust. So if a trustee is giving a declaration or has signed a declaration that all the obligations of FATCA CRS, which the trust has to undertake, that I will now undertake as a trustee of that trust. So in that scenario, the trustee needs to ensure that he is doing the obligations on behalf of the trust. Only in that scenario, it will be classified as a non-reporting financial institution. Otherwise, the trust will also have to carry on the trust will have to carry on the FATCA CRS compliances, as well as the trustee if he is falling in the category of a reporting financial institution. The third category provided is investment advisors and managers. So here also, the idea is that, there are certain fund managers and advisors who are broadly giving advisory in terms of where to invest and all. So what the authorities thought of is, okay, let's not burden those entities with all the reporting obligations. But the only criteria which they have kept out here was, if the fund which you are managing as the account holders, which are itself a reporting institutions, only in that scenario you qualify as an investment advisors. So let's take an example out here. There is a fund manager, which is company ABC Limited. ABC Limited is managing a fund, which is XYZ. Now, at every investment in XYZ, the fund manager has to ensure that the investment which they are receiving, that particular entity has to be classified as a reporting financial institution. Only in that scenario, you are given an exception. Otherwise, it is better that you compliances by yourself. See, the whole genesis or the whole idea of this compliance is that, if one person is carrying on a reporting to the authorities, then the same person need not do the reporting to the authorities about that particular person. So there is a structure. Let's take a structure that company A is holding 100% shares in company B, and that company B is holding 100% shares in company C. Now, if the company C has to do the reporting, what it will do is that it will do the reporting for company B as well as company A, because the ultimate beneficial owner is company A. In that scenario, company A and company B need not do the reporting because their information is already shared with the authorities. So after having analyzed that, what are the reporting financial institutions? Let's have a look at who are the reportable account holders for whom the information needs to be shared with the authorities. So this can be broadly classified in three areas. First is the specified US persons, the reportable persons, and the controlling persons of the passive NFEs. Now, who are called as a US person? So US persons are defined as, first, you have to be a US citizen. Second, either you are a resident of the US, or third, your entity has been incorporated in US. Then you would be classified as a specified US person. Coming to the second category, which is the reportable person. So the idea is same. The US persons and the reportable persons, in both the scenarios, it is going to be the individual account holders only. But just for the simplifications, we say that US person because he is based in US. And for the reportable persons are any person or any account holder which has been onboarded by the entity and it belongs to the reportable jurisdictions. Now, when we talk of a reportable jurisdiction, it means that UAE has signed an agreement with that particular country to exchange the information about the persons. So if a particular citizen is a resident in that particular country, then that account holder classifies as a reportable person. So it could be Korea, it could be Singapore, it could be. So if you have onboarded investors who are residents of this particular country, then you need to ensure that you are reporting information of this of all those account holders in the CRS filings. The last category is a passive NFEs, which has a controlling person who is either a US person or a reportable person. So before going into the more detail about, who is a passive NFE and a controlling person, let's have a look at what are passive NFEs. So passive NFEs are those entities who are purely earning incomes which are passive in nature, for which they don't have to do any extra effort and it is easily received by them. So this could be, the entity which is purely earning income from dividend, or it is earning income from interest. So those, or it is earning income from rent. These kind of activities, these kind of entities are classified as a passive NFEs. However, so this was a very layman definition for a passive NFE. But if we look at the definition under the regulation, it says that any entity which is not an active NFE will be classified as a passive NFE. And if one has to look at the definition of active NFE, so there are multiple criteria which has been given. First, that the entity should not be earning more than 50% of the passive income, or it should not be owning more than 50% of the assets which generate passive income. The second category would be, if an entity has been listed on a stock exchange, which is regularly traded, so that particular entity is classified as an active NFE. So likewise, there are many other criteria which has been given for the definition of active NFE. So the idea is that, where the authorities know that, okay, you are doing a proper business, or you are doing a genuine business, which is in the ordinary course of your activity, or the main purpose is that, there is no, or the authorities feel that there is not going to be any tax evasion from this particular entities, are classified as an active NFEs. So now coming back to the last category, which says that who are the reportable account holders, is if an entity which has been classified as a passive NFE, and that particular entity is either owned by a US person or a reportable person, that we immediately look, that if you are belonging to certain other jurisdiction, then the entities, the passive NFE has to ensure that while they are submitting their documents to the fund or to the companies, they need to declare who is the ultimate beneficial owner in that company or who is the controlling person in that company. Because this will enable the entity to do the reporting properly. So now, as we discussed, the first step in FATCA CRS compliance is that first we have to do the entity classification. Once we are done through the entity classification, the next step which comes is, now what is more that we need to do? So that is the due diligence requirements, or we may say that the due diligence compliances that they have to follow. Because this is the most important step in FATCA CRS compliance, because this will enable the entities to know who are the reportable persons and who are not the reportable persons. Because, in the event, if there is any error on part of the entity to identify that there is a particular reportable account which has not been reported to the authorities, there are huge penalties for that. So it is always better to have proper systems in place or proper due diligence exercise in place, which will help the entities to identify whether I have to report for a particular account or not. So just to due diligence exercise has been divided in broad two categories. First is pre-existing accounts and one is a new account. When we talk of pre-existing accounts, so these accounts are opened by an entity which are prior to 31st December 2016. So it may happen that, the entity was incorporated in UAE. The entity was incorporated in UAE before 2016. So it had onboarded investors. Now, come 2017, where UAE decided that, okay, fine, we will have this FATCA and CRS regulations in place. So they decided, okay, then what should happen? Whether it has to be only for the new investors that we will be onboarding, or it has to be also to the existing investors which we have. So to proper mechanism in place and to streamline the process, they thought that let's have a cutoff date of 2016, and any account which has been opened prior to that date will be classified as a pre-existing account, and account which has been opened after that date will be classified as a new account. So the idea is that, for the existing accounts, there are more stringent provisions or more stringent due diligence exercise which needs to be followed rather than the new accounts. Because if I'm opening any account today, I know what care I have to take for those accounts. But for the account which has been opened prior to that date, there was no mechanism in place. So therefore, government has said that fine, what we will do, if you are having any account holder, which is a purely annuity contract account holder or which is a cash value contract, then you need not review those accounts. The second category is the low value accounts. When we talk of a low value accounts, so there is a prescribed limit which has been given. And it says that if the account balance of that particular account holder as on 31st December 2016 is less than or equal to that particular amount, then it will be classified as a low value account. And while we are doing the due diligence for those particular accounts, what all checks that needs to be have in place? So one is the residence address. Now, when we talk of residence address, so it is that, when you have onboarded the investor, you need to ensure that the documentary evidence that the account holder will have submitted, address mentioned in that documentary evidence, vis-a-vis any other certification that you would have obtained from that particular account holder. And you need to check that what is so let's say if the address mentioned is of a particular jurisdiction, which is agreed with the UAE for exchange of information, then that particular account holder will be your reportable account. The second test is record sets. In case of electronic record search, nowadays with the things becoming digital and a lot of or in terms of the tax residency, that as to which particular jurisdiction the account holder is pertaining to. So then they did not carry on any further search, and based on the results which have been obtained, they can determine the classification whether the account holder will be a reportable or not. Now, when we talk of the enhanced review procedures, the enhanced review procedures are nothing but for high value accounts which are being maintained by the financial institutions. So in terms of the electronic record search, as we discussed, it is similar to what we do it for the low value accounts. The second is the paper record search. Now this particular step need not be done in the event, all the information. So when we talk of the information is like, I'm able to get proper tax residence of that particular account holder from my electronic record search, or the TIN number of that particular account holder, the address of that particular account holder. In that scenario, I did not go on to the paper record search and I can directly conclude it. But if the systems are not in place, so then what I will do is I will have to conduct an additional search or an additional exercise, which is I will have to go through all the physical documents of that particular customer to find out what is the recent documentary evidence which I have obtained from that particular account holder. And based on that, I will determine. The third category is the relationship manager. Now, normally today we, for all the accounts which has been opened, we allot a particular relationship manager to that account. So the relationship manager is a spoke for that particular account holder who gradually talks with the customer, to have an insights as to where the customer belongs to, because in that scenario, it could be that initially when the customer had opened the account, he was a resident of Korea, but now he has shifted to USA. So when the relationship manager has a discussion with the customer, he gets to know the proper knowledge of him. And accordingly, based on that, determination can happen. And the last step is the standing instructions. Now, standing instructions are nothing but that, today I would have written a mail to the particular entity that any communication that you are addressing to me or to this particular account needs to be on so-and-so address or on so-and-so telephone number. In that scenario, what will happen is that will give an indication to the entities, okay, that the customer has already told, that he is not a resident of this particular jurisdiction, but he is belonging to some other jurisdiction wherein he wants the communication to be sent. In that scenario, it will not be the customer will then be classified as a reportable person of the jurisdiction to which he has given a standing instruction. And lastly, the reporting for this particular account holders will be, it will continue till the time the account holders does not ceases to be a reportable person under the FATCA CRS compliances. Now, having talked of pre-existing account holders, let's look at what happens in case, if I'm onboarding a new individual accounts today. So broadly, it is a very simple process. Any individual account or any account which I'm opening up today, I need to obtain a self-certification from that particular account holder, which will form part of my documentation and which will also give me details about the TIN number, the date of birth, the tax residency, and the address, because these are the basic fields which we need while filling up the CRS or the FATCA returns. And this will also help us to determine the classification for the account holder as to whether it is reportable or not. Moving ahead with having discussed about the due diligence exercise for the individual accounts, let's look at what are the provisions or what are the regulations that need to be followed in case of an entity accounts. So firstly, they have also given, just like the individual accounts, they have also given a cutoff that if an entity is having an account balance of USD 250,000 as of 31st December 2016, then we are not supposed to review those accounts unless and until the account balance exceeds USD 250 in the subsequent calendar years. So supposing in in 2016, the balance was less than 250,000 USD. Come December 21, the account balance is 500,000 USD. So while doing the reporting in July 22, the entities will have to take care that this particular account needs to be reviewed and analyzed for reporting purpose. And similar to, see, as we looked at, for the financial institutions, who are the reporting entities. So it is only the passive NFEs who classify for a reporting purpose. So therefore, first step for determining, whether the entity is reportable or not, we need to check the entity, the residential status of that particular entity, and also the residential status of the controlling persons, because both these categories are required to be analyzed. Provisions for new entity accounts is more or less similar to what we look for the individual accounts, except one additional requirement out here would be the entities, while obtaining a self-certification declaration, the entities will have to ensure that they are also giving details of a controlling persons. Now, broadly, I would like to discuss some challenges or some issues which are being faced while carrying out due diligence, and which entities can take care of. Because the initial, the acceptance of forms happens when the account is onboarded, but the reporting happens at the year end. So there is a lot of time gap between these two. So to ensure that, you don't have to run back to the account holder at the 11th hour and ask for the additional information from him, it is always better that certain steps or certain mechanism is there in place to ensure a proper information is available with us. So few of the instances are, while we have a look at the self-certification forms, it so happens that the self-certification form is incomplete. Now, incomplete in terms of certain individuals who have not provided their TIN numbers, even if the TIN has been issued by the authorities. And, it is just accepted on the face value that, okay, this form has been received from the account holder. Let's collect and put it in the file. No, that's not the only step which has to be done in the due diligence exercise. What more needs to be done is, so if he has given you, if he has mentioned his residential address in the self-certification form, the users needs to then map it with the documentary evidence and ensure that the address mentioned out here is correct. Because it should not happen that I am giving one address in a self-certification form, whereas my documentary evidence says another address. This would be completely a false self-certification which has been given by the entities. And in fact, the authorities have been placed sanctions in case if the self-certification form has not been correctly provided. So to ensure that, the sanctions are not imposed, these basic steps can be followed. Thirdly, there has been few instances where the account holders don't provide GIN numbers in order. Now, this GIN number is nothing but a global identification number, which has been allotted to all the financial institutions. So if you are a financial institution, you need to register on the IRS portal and you will be allotted a particular number. And this number is ideally used while doing your submissions for FATCA and CRS. So it happens that, and there is a proper length. So there is a 16-digit character which has to be there for the GIN number. And this, while the self-certification form will mention only 7 digits or 8 digits. So to avoid and ensure that, it is complete, these basic steps or checks can be in place. And while the certain account holders would have provided you with the correct GIN number, you should not be accepted on the face value. You need to take one additional check that all those GIN numbers which has been allotted on the IRS portal, you can verify for yourself whether the GIN number which he has mentioned in the form is matching with the GIN number in the search that you can carry out. Lot many times it happens that, the details of controlling persons are missing in the self-certification forms. So today I have accepted a form from a passive NFE and he has just provided the information about the entity. But if you are a passive NFE, the obligation on you is that you need to also provide details of controlling person. Unless and until these details are provided, the form which has been submitted to you is incomplete. What will happen is you will have to go back to the account holder while you are doing the reporting, and then you'll have to request from him that you please submit the details of controlling persons. This may, first, it will create a lot of hassle for you. Second, it is a waste of time for you as well, because this could have been avoided at the initial stage. Lastly, it has been seen that while the details have been received from the client and the account code which has been given to that particular client, they are not tagged correctly. So the account will be belonging to Mr. X, but the documents are pertaining to Mr. Y. So in order to ensure that, while carrying out due diligence, at least somewhere the client code which has been given to that particular person is tagged with them. So during the course of, even during the course of the assessment with the FSRA authorities or the DFSA authorities, it would be easy reference for you. You can collect those forms and you can immediately submit it to the authority. So all those basic checks that needs to be there in place, while carrying on the due diligence exercise. Moving further, as we all know that Ministry of Finance has launched this new reporting portal in the month of May, but somehow, the portal was not functioning correctly, or there were some issues. The ministry took the cognizance and they have extended the due dates. But what really is this portal and what was the need for it? Initially, for the reporting to be done, it was that if the entity has been located in the DIFC region, they used to go on the DIFC portal and they used to do the submission. If the entity is registered with ADGM authorities, they used to go on that particular portal and do the reporting. So there was multiple portals in place while the reporting was happening for one particular objective of the UAE authority, which is the FATCA CRS compliances. So the authorities thought that let's have a single portal wherein, there can be FATCA CRS submissions, and also there can be the CRS risk assessment submissions, which can be taken care of. And that's the reason this new portal was launched. So just to give you a broad perspective, as to how this portal functions is, for each, this is a one-time exercise. Firstly, let me clarify that this is a one-time exercise for all the entities, which they have to do it in this particular calendar year. In the subsequent years, there is no requirement of doing a registration, and they can simply log into the portal and submit the returns. First of all, the entities will have to register themselves. And for the registration, I've just given a snapshots of, what they have to actually do. So first you need to go on the portal, which is fatcacrs.mof.gov. And there you will have to click on the new user. Once you click on the new user, you have to select whether you are a reporting entity or not. Based on that, the registration process will start. Now here, the idea of this entire portal is that, whenever the submissions are made, there is a maker-checker concept. So one, the person who prepares the return, and second, who will review the returns which has been prepared and submit it with the authorities. So the first registration will happen for the checker user. Checker users need to provide their email ID. They will receive the OTPs, and post that the registration will happen. Post that the registration will get concluded. And while doing the registration also, they need to give certain information about the entity. That is the GIN number, the address details, the license number which has been issued by the relevant authorities, and what kind of an entity you have been classified under FATCA CRS laws. Once those details are submitted, the approval will go to the relevant authority and they will approve the checker user. Unless and until the checker user has been approved by the authorities, you will not be in a position to go further. So post completion of the approval, you can add as many users as you want. So you can add multiple checkers. You can add multiple users also. Multiple checkers and multiple makers for the same entities. And also now there is one more functionality which has been which has gone live, is that under the same checker ID, you can add multiple GINs. So the idea is that, as a group, you are having say 10, 15 entities. you cannot have 10, 15 different people for maker and 10, 15 different people for checker. So they ensure that a single checker can be a checker for all those 10 different entities, and then you can do the submissions. Once the checker user has been approved by the authority, you need to add the maker user, and post the maker user has been added, what the checker user will have to do is that he will have to log into the portal. He will have to go under the tab admin approval. And from here, if you can, on the first screenshot which has been placed, number of users will appear. And there you can active or inactive any of the particular users. So this is to ensure that, if particular user who was there with the organization earlier and now he is no more with the organization, so you may simply inactivate that particular user. Coming to the last part of the webinar, which is the CRS risk assessment. Now, initially, this CRS risk assessment was not there in place prior to calendar year 2020 reporting. So what the authorities thought that, because they are also obligated to ensure that, all the entities are not burdened with the compliance process, or to ensure that, they are doing the reporting correctly. They said, let's do one thing. The entities will have to first complete this assessment on their own. So that is, they will classify themselves. There is a 13-pointer questionnaire which has been given. You need to provide answers to those questions. Based on the responses which has been provided, the authorities will classify you under 3 different categories, which is the high risk entity, low risk, or a medium risk entity. Depending on that, the entities will then take up the case for assessment, or maybe review. So it is very important, and if one has to look at the risk assessment process, so it is such that there are few questions like whether the entity has CRS training in place, whether the entity has policy and procedures in place. Now, while you are answering those questions, it is very necessary that you answer it appropriately, because depending on that, the authorities will then have an idea or draw an inference that, okay, there is a proper compliance team in place who is aware of this FATCA CRS compliances, and based on that, the reporting is happening. So, given the broad perspective of why this CRS risk assessment was brought in picture, let's have a look at how the submission will happen for the CRS risk assessment. So this submission is similar to what we do for the FATCA CRS reporting as well. The only difference is that here there is a predefined set of questions which has been given by the authority, and there are multiple options which has been given. Based on the responses, based on the questions, the user will have to provide a responses to those particular questions. Once the responses are given, maker user will have to submit those responses. And at the last step, user will have to approve the submission. Once the submission is approved by the checker user, it will go to the relevant authority, and then the authorities have all the necessary information in place. So here, we are just trying to capture the overall perspective for the calendar year 2021. While the self-assessment started in the month of January, the account holders who are in DIFC needs to intimate to the account holders that because you have been identified as an account holder and your information will be submitted to the authorities, this is just an intimation to you. And that intimation has to be given by 28th of February after every calendar year. The next step after June, it comes after February, the deadline is the June. Currently, it has been extended to 20th July, but your annual reporting and your risk assessment will happen in the month of June. Till last year, what we understand was that there were different dates for annual reporting as well as the CRS risk reporting. But this year they have consolidated both the due dates and they have kept it as one only. And post your submission, the authorities will then select your case or then select your submission, whether they want to further assess and to ensure that there has been complete correct and complete responses which has been provided by you. So in the month of September, October, they would be providing you with your questionnaires. This is to ensure that there is a proper check and mechanism in place by the authorities also, because in the event if the UAE fails on its part to provide a correct information to the participating jurisdiction, there is a penalty which has been imposed by the participating jurisdiction as well. So this is all from my end regarding FATCA CRS compliances, and we now open the floor for discussion. If anybody has any questions, we are happy to address that.
Thank you, Mihir, for this wonderful presentation. And I would also like to thank Trupti for joining us today. I'm sure the listeners too have found this relevant. If you have any questions in line with this discussion today that we were unable to address due to time constraint, we welcome you to reach out to us at thinknext@nexttime.com, and our team would be happy to respond offline. Across the globe, we think next at next time and invite you to do the same. We welcome your feedback on today's presentation. Thank you and goodbye.
Thank you, everyone.